Hello, welcome to another video. I'm going to be talking how to backtest a trading strategy. Now let me begin with a metaphor. Imagine driving forward while only looking in the rear view mirror. It can help us learn from the past road conditions, but it's no crystal ball for how the road ahead will look. You can relate this idea to a backtest. You have past information, but you must use it responsibly and with caution because it does not fully reflect future data. It's a straight road, then past will perfectly capture future conditions. But if it's not, it'll behoove you to look only into the future. Now I'm going to give a definition of a backtest. A backtest is the process of applying a trading or investment strategy to historical financial data in order to compute the past hypothetical outcomes, such as returns, risk measures, and performance statistics that would have been realized had the strategy been implemented in the past under the assumption that prices and market conditions are an adequate proxy for the environment in which the strategy will operate. So what does a backtest consist of? It consists of data, past prices, strategy rules, simulated trades, and performance metrics. So data is historical time series data, right? So most of the time when you do a backtest, it's going to be time series. And then you could trade on multiple time horizons. The strategy rules are the logic or trading models that generate signals to make decisions. Quantitative strategies generate from time series analysis and machine learning, or technical analysis. We'll be going over technical analysis as an example in this video. So simulated trades, each buy and sell decision that would have occurred if your strategy had been applied to the historical data. This includes entry points, exit points, trade size and positions, and accounting for fees, slippage, or other constraints. So finally, performance metrics. Measures like total return, sharpe ratio, drawdown, or win-loss ratio calculated based on simulated trades. So we've got the sharpe ratio. RP is expected return of the strategy or portfolio. RF is the risk-free rate, often proxied by treasury bills. Usually it's going to be 3 months because this is trading is usually short term. And then sigma p, which is the standard deviation of strategy volatility. So sharpe ratio intuition, it tells you how much excess return you're earning per unit of risk. A high sharpe ratio means better risk-adjusted performance. Example, a sharpe ratio of 1 means 1 unit of excess return for each unit of volatility. The second performance metric I like to talk about is max drawdown, and that's the highest price minus the lowest price after peak divided by the highest price. So for example, if a peak value is at 100, the lowest value after peak is 70, the drawdown is about 30%. And you can see this here, what a drawdown basically is. 105 to basically around, I think, like 92 or so. Okay, so that's the maximum you could lose. It's important to kind of keep this in mind when you devise a trading strategy, because you always want to think about the worst scenario, right? So this is the maximum drawdown. This is the maximum amount you could lose. Here's a technical analysis example of a trading strategy. Basically, it's a moving average crossover from 5 days to 30 days. And you see the signals here that are generated. The green arrows are basically a buy signal. The red arrows are sell signals. So we could backtest multiple trading strategies, right? If we've got moving average crossovers of 3, 5, 10 as its parameters, and then the moving average crossover 2 is 15 to 30, 15, 20, and 30, we could generate 3 strategies, right? From 3, starting with 3 as the first moving crossover strategy. We could generate another 3 from 5 starting as the crossover moving average crossover strategy, and another 3. So that's a total of 9 MA crossover strategies that we could actually backtest and see how it performs based on the risk measures that we talked about, Sharpe ratio and maximum drawdown. So every test begins with a question: what pair of cross-trading strategies perform the best? In other words, what maximizes the Sharpe ratio and minimizes the drawdown? So that's the question that we are concerned with in terms of when we backtest the strategies on the data. So let's think of the logic that would be used in the code and how we would code it. First, we have the inputs, obviously, that I mentioned, the short-term moving average window, the long-term moving average window, and the price series. It could be historical or simulated. The reason why you would simulate it is because if you want to add conditions that might not be in the original historical data, so for example, earnings announcements or macroeconomic shocks that might not have been in the data. So you want to see how your strategy would perform if you perturb or change the data to kind of fit your hypotheses about the future. The logic part 2, as we saw earlier, we generate valid MA pairs. I mean, in coding terms, that's just basically a double for loop, right? So we saw the 9 possible combinations. And then for each valid combination, we compute the moving averages, the short and the long, right? If it generates trading signals. If the short is greater than the long, it's a buy signal, okay? If it's less than the long, it's a sell signal, okay? So important is that the shift the signal by 1 day to avoid look ahead bias. You can only act on information you would have known yesterday. So this prevents cheating by using today's closing price to trade today. Ensures the backtest simulates realistic trading. Then you compute strategy returns, which is the signal times the daily price return. The equity curve is basically a cumulative product of 1 plus the daily return strategy. Right, so the equity curve is basically measuring how long you perform in the long run. And you compute performance metrics like the Sharpe ratio, the max drawdown, total return, final equity minus initial equity, the win rate, which is basically the times you're right versus the times you're wrong, and the number of trades. And then finally, you would rank all the strategies, the highest Sharpe ratio being the primary, the secondary being the lowest absolute max drawdown. Right, so the output would be the best moving average crossover pairs that optimize for those 2 metrics based on its performance metrics. So I'm going to give an example here. And here we've got the best trading performance strategy of 10 and 20. Okay, the annual sharpe is 0.94. The maximum drawdown is 11%. The total return is 29.26%. The win rate is about 50%. Number of trades is 25. And the absolute standard deviation is 11%. So this was ranked, right, from the highest sharpe down ratio to the lowest and the minimum maximum drawdown. So how should you use the output and what questions would you ask? I mean, the reason why it's good to be critical of the output is, like I was mentioning earlier in the beginning of the video, that it's kind of looking at the rear view mirror and seeing how past conditions behave and then thinking that it's going to happen in the future. So that might not necessarily be the case. So if you believe, if you have a high conviction that the future will perfectly align with the past, you have a strategy that will correlate well into the future. So if you believe the past is perfectly going to align with how future conditions will look like, you probably want to use this strategy. But you should always look for possible disconfirming evidence. Will there be anomalous events that would disrupt this pattern? You can create simulations with anomalous events using macroeconomic shocks, earnings announcements, geopolitical events, and et cetera, et cetera. And how much money am I willing to risk on this strategy? And short-term, I want to make the last point is that short-term forecasts are more accurate than long-term forecasts. Okay, so, you know, like a day ago or 2 days ago is more predictive than a month ago of how the price series will behave. Thank you very much. Hope to see you soon.